$600 of your annual dividend income is vanishing to taxes, and most dividend investors have no idea it's happening. You probably think 4% yield is straightforward. Buy it, collect the dividends, reinvest, or spend them. That's the pitch. But here's what the prospectus doesn't emphasize. Those dividends are taxed as ordinary income, not capital gains. For households earning $100,000 to $250,000, that means federal tax rates between 24% and 32%, plus state taxes. The research shows the total tax drag averages 20%, turning that 4% yield into a real 2% after taxes. On a $100,000 position, that's $600 a year in lost income every year forever. By the end of this video, you'll understand exactly why high-dividend ETFs create this trap. See the specific numbers proving it costs you more than you think, and know one strategic move that can reclaim some of that income. If you're managing retirement income or building passive cash flow, this changes how you should think about dividend investing, so stay with me. First, let's break the wrong belief most dividend investors hold. The assumption is simple. High dividend yield equals stable retirement income with minimal tax friction. Trades on this promise. Schwab markets it as a quality dividend grower, and the 5% to 2% yield looks attractive compared to bond yields. But the IRS doesn't care about the marketing. According to IRS Publication 590B, ordinary dividend income, which is what pays, is taxed at your marginal rate, not at the favorable 15-20% capital gains rate. For someone in the 32% federal bracket, add another 3-5% in state tax, and you're looking at 35-37% total tax on every dollar of income. Here's the concrete math. Imagine you invest $100,000 in. The current yield sits around 8%. That's $3,800 a year in dividends before taxes. Now apply a realistic 37% total tax rate, federal plus state, for a high-income household in a state like New York or California. You owe $406 in taxes. Your net income, $394. The effective yield drops from 8% to 4%. For every $100 pays you, taxes take $37. Over a $500,000 position, common for retirement portfolios, that's $7,030 lost annually to taxes. Most investors never calculate this. The reason it matters now is that interest rate volatility in 2024-2025 has reset dividend expectations. When yields were lower, a 8% dividend felt exceptional. But bond yields are now competitive. Treasury rates sit at 5%, and the dividend yield advantage is shrinking while the tax liability stays fixed. You're not getting rewarded for the tax drag the way you used to. Here's the delta that changes your retirement math. The gap between the advertised 4% and the actual net 4% or 2% is not 0. 8%, it's a permanent hole in your income plan. On a $250,000 position, that's a $2,000 to $4,000 annual opportunity cost. Over 20 retirement years, assuming no growth, that's $40,000 to $80,000 in retirement income you plan for that vanishes. The research from Tax Foundation confirms that dividend-heavy portfolios in taxable accounts carry a hidden efficiency cost of 15-25% annually compared to growth-focused or tax-managed alternatives. So what can you do? First, understand your tax bracket now. If you're in the 24% federal bracket or lower, might work in a taxable account. If you're at 32% or higher, the tax drag becomes severe. Second, consider holding inside tax-deferred accounts, 401(k)s, IRA, or SEP IRA, where dividend distributions don't trigger annual taxes. Third, look at alternatives like VYM or tax-managed dividend strategies that distribute less frequently or focus on qualified dividends, which cap out at 20% federal tax. The research shows that shifting a $100,000 position into a Roth IRA eliminates the entire $600 annual tax drag permanently. The full breakdown with implementation checklists is in the companion book, The Compound Interest Bible. Link in the description if you want the spreadsheets and source documents. The biggest takeaway: high dividend yield and high tax efficiency are not the same thing. It pays reliably, but the tax cost is stealing from your retirement income silently. The fix is knowing which account type to use and which alternatives fit your bracket better. If this changed how you think about dividend investing, hit subscribe. Next video covers the 3 dividend ETFs with the lowest tax drag, dropping Tuesday. Ring the bell so you don't miss it. What's your biggest position and where do you hold it? Drop it in the comments below. Stay informed. See you in the next breakdown.